Today we will discuss on the different policies adopted by the companies regarding the dividend. Actually, as an investor, when we invest in shares, we must know why companies are paying the dividend and when they should pay the dividend and why they are not paying the dividend. Actually, there are some policies, there are some theories which defines these behavior. If we talk about the financial management, we know that the main objective of financial management is to maximize the wealth of the shareholders. Every company should work in such a way that the wealth of the shareholders should increase, right? And why as an investors we are investing in equity shares, because we want good returns, we want the benefits from the investments. Now today we will discuss the various theories which can explain these kind of behaviors. Now, as an equity shareholders, how we can maximize the wealth, or how the companies can maximize the wealth of the shareholders? There are some measures like EPS should be maximized, the corporate benefit should be as large as possible, and there are many corporate benefits which includes like dividends, like bonus shares, stock splits, right issues. These are different kinds of corporate benefits that investors are getting from the companies. Now first we talk about the dividends. What are the dividends actually? When company made the profits, the main important issue in front of the finance managers is that whether they should retain this dividend or the pay these dividends. So this is the big issue, and whether to pay the dividend to the shareholders or whether to retain it, how they decide that, because whether this decision is influencing the shareholders' wealth or it is irrelevant to the shareholders' wealth. So this is the issue, and there are many theories which explain these kind of behavior. We can divide these theories into two categories. One is relevant theories. These theories say that the dividend decisions or the dividend policies influences the market price, influences the book value of the shares. So dividend decisions are very, very important. The finance manager should consider these kind of decisions very carefully. And some theories say that there is no impact of dividend policy on the market price of the shares or the value of the firms. The dividend relevant theories, for example, Walter model say that dividend policy are relevant, but basically Walter model classifies the companies into three categories. These three categories are: one, where the company is able to invest the money where they can earn more returns as compared to the returns expected by the shareholders. Actually, there are two types of rates. First, we have to understand these rates. One is reinvestment rate. If as a businessman you are having the amount which may come from the profits, now whether you want to invest it further in the business or you want to distribute as a dividend. So this we have to consider. There are many issues which can influence these decisions, like if the market is booming, the demands are increasing, and in that condition, it is much better to reinvest the amount rather than distributing it as a dividend. Why? Because investor may expect us to provide 12% rate of return or 16% rate of return, but we know that we are having such investment opportunities where we can earn much better returns. So in this condition, whether we should retain the dividend, retain the profits, or we should pay it, right? So as a common sense, we can understood it very easily that if we are having good opportunities, then in this case, it is better to reinvest the amount rather to pay it as a dividend, because in future you are able to pay more returns to the investors, right? So in this case, when the company is having good investment opportunities to invest the amount, they should retain the profits rather than paying it to the shareholders. This this happens is uh, this happens only in the case of growing firms, when the reinvestment rate is more than the rate desired by the equity shareholders, which we know that it is called cost of capital, right? Now there are so many firms where there is no investment opportunities. In fact, they are struggling with their profits. Their profits are declining. In this case, if you compare the reinvestment rate or the cost of capital, we can compare that the reinvestment rate is less than the cost of capital. So these firms are known as declining firms, and the Walters suggest to these declining firms that they should pay 100% dividend. Whatever profit they are earning, they should pay to the equity shareholders, because they are not having any investment opportunity. They are not having good investment opportunity where they can put their profits. So better they should provide it to the equity shareholders. Now, in between these two extreme type of companies, in one extreme we are having growing firms. We know that the telecom sector is growing at a very fast rate, and even IT sector is growing. Realty sector, the realty sector is growing at a very good growth rate. But on the other hand, where we are having those industries where the growth rate is less, there is no investment opportunities. So we can divide the companies into these two extreme categories: one where they are growing, one they are declining, and in between the two extremes we are having another category which we call stable firms. Stable firms are those firms where the cost of capital or the rate required by the investors is same as the return they can earn. So what the company should do in this case? The theory suggests that in this case, if they pay the dividend, then it's okay. Otherwise, they can retain it. But in dividend policies, in the literature explaining the dividend, there is one theory which is known as bird in the hand theory. Bird in the hand theory. So as the name suggests, as an investors, we are having two options. One, stay with the investment and earn high capital gain in the future, right? So whenever we invest in the equity shares, and if we stay invested for a long term, we can earn the capital gains. And in addition to that, the company also provide dividends per year. There are two types of dividend. One is final dividend, which company declares at the time of annual general meeting, and they in between the financial year, they can also declare the interim dividend, right? Why these dividends are important? Because they are quick gains. They are quick gains. If you invest, take the money back, and in addition to getting the dividends, you are still staying with the investments. So the literature say that most of the investors want this quick dividend, and especially when the market is not at boom, when the GDP is not growing at a very high rate. For example, nowadays we saw that the stock market is not moving high at a very good rate. From the last 1 year, we are stable. When the market is going down, market is going up. So in such a case, demand is not growing, the sales are not increasing, market is not expanding. So even if the company is growing, they should pay the dividend. Why they should pay the dividend? Because This indicates the good policy, the good management. At this time when you are not having any good investment opportunities because the market is not moving up. In such a case, this is the suggestion to the companies: if they want to increase the market value, if they want to increase the market price, they should pay the dividends. So, in total, in we can summarize this. Walter say that there are three types of firms: growing firms, stable firms, and declining firms. Growing firm should not pay the dividend. Their dividend payout ratio should be as least as possible, and the stable firms, whether if they pay the dividend, then it's good. Otherwise, they can retain it. Theory say that there is no relation of dividend policy with the market price, but practically when the market is down, these companies should pay the dividend if they want to increase the value or to the equity shares. And in third extreme, the declining firm should pay as much as dividend as they can. So this theory is relevant theory, and the second relevant theory is explained by the Gordon. Gordon focuses more on the retention ratio. Retention ratio is the ratio. Suppose you are making the profit of 100 rupees and you are paying the dividend of 10 rupee. In that case, your retention ratio is 90%. Right? Dividend payout ratio is just opposite to the retention ratio. Example, if earning is 100 rupees and company is paying, earning means earning per share. If earning per share is 100 rupees and the company is paying 10 rupee, in that case the dividend payout ratio is 10% and the retention ratio is 90%. Right? So the Gordon focuses on the retention ratio. Right? Gordon say that if the company pay the dividend, that in that case the company is left with less retained earnings, means less investment in new projects. It means less growth in the future. Right? On the other side, if you retain all the amount, all the earnings, and reinvest this earning in some other projects, good projects, it means there is no current earnings in the form of dividend to the equity shareholders, but in the future company can grow. Means growth rate is very high if company reinvest all the retained earnings in new projects. Right? Now there is an issue in new projects. What is the reinvestment rate? What is the reinvestment rate in the new project? If the reinvestment rate is more than your required rate of return or shareholders required rate of return, it means company can invest, company can go to the new project. And if reinvestment rate is less than cost of capital, the company should distribute. So Gordon explained the same behavior in terms of retention ratio. So Gordon say that again there are three type of companies where the reinvestment rate is more than cost of capital. Company should not pay the dividend. Company should reinvest all the earnings in new projects so that they can provide more capital gains in the future. More capital gain in the future. And in case if these two are equal, if reinvestment rate is equal to the rate expected by the investors, in that case the Gordon advised to the company that they should pay the dividend rather than retaining it. And in third case, where the reinvestment rate is less, the company should pay all the dividend. So basically the Gordon model and Walter model explain the same thing. And in addition to these two relevant theories, there are some irrelevant theories. The most important, most famous irrelevant theory is explained by Miller and Modigliani. In short form, we call it MM theory. Now Miller and Modiglani theories say that the dividend decisions are irrelevant to the valuation of the firm. There is no impact. There is no impact of dividend decisions on the market price of the share. And they explains this in another way. They gives the theory of arbitrage. Arbitrage means, as an investor, we want returns, whether it comes through dividend or it comes through capital gain, does not matter. In long term, it does not matter, right? And there are some other forms of corporate benefits. In addition to the dividend, the company can pay the bonus shares. The company pays stock split and right issues. So what is the difference between these corporate benefits? All comes in the corporate benefits provided by the company to the equity shareholders. Let's start with the bonus shares. Bonus shares. Bonus shares are the additional shares that the shareholders can have. For example, if company issue the bonus share in the ratio of 1:1, 1:1, it means the investors who are already having one share, they have one additional shares. They have one additional shares. They are not getting any cash value in terms in case of bonus shares, but they are having more number of shares. Now the question comes in our mind that why company should pay bonus shares, or when company should pay the bonus shares, and how market respond to the declaration of bonus shares. There are many research on this topic, and the researchers found that whenever the company announces bonus shares, uh, the market respond positively. It is actually good sign for, and the results indicates that when when the company declares or announces the bonus shares, the market price starts going up, and increasing in the price of the shares indicates that there is a positive response come from the investors to the market price of the share. And basically, in case of bonus shares, the face value of the firm will remain same. There is no change in the face value of the firm, right? So it is good. Second, when the company is having enough cash reserves and they don't want to pay the dividends, actually they want to reinvest this cash in some good projects. So in that case, rather than paying the cash dividends, they prefer to pay these bonus shares, these additional shares, because issuing the bonus shares increases the number of shares, and if there is a increase in price, we can also say that the market capitalization of the share also increases. And if market capitalization of the company increases, it is a good sign for the company. And another corporate dividend we can describe is stock split. Stock split and bonus shares they're basically the same from shareholders point of view, because from shareholders point of view, in case of bonus shares, they are getting more number of shares. In case of a stock split, they are again having more number of shares. But there is a slight difference between the two. One, the face value of the share will not remain same. In case of a stock split, actually it is split in the same ratio. For example, if the bonus share announces by the company is in the ratio of 1:2, and another company also announces the stock split in the ratio of 1:2, in case of bonus shares, the face value remains same. But in case of stock split, the one share is split into two shares, and if the face value of if the share is 10 rupees, now it comes down to 5 rupees. So actually the face value of the company also is split in the same ratio. And the basic reason of issuing the stock split is to increase the liquidation, because sometimes we found that the market price are very high, and because the market price are very high, investors don't want to invest in these shares. So practically in the market the liquidity comes down, and if the liquidity comes down, uh, the the capital gain is also less, and the company is interested in increasing the liquidity. So the best way to increase the liquidity, especially when the market prices are very high, is to announce stock split. For example, Educom. I remember that 3 years back, the price of Educom was around 4,500 or 5,000. In that case, the company announces the stock split in the ratio 1:10. So after announces the stock split, the share price come down to around 500, and it is found that after stock split, the liquidity increase in the market. So to increase the liquidity, company issue the stock split. Basically, why we are discussing these bonus shares and stock split in dividend lecture, because they are the corporate benefits, which um, they are the form of corporate benefits, and dividend is also a corporate benefit. Sometimes as a from the point of view of shareholders, we should consider the importance of all these corporate benefits. We are also having other corporate benefits like right issues, but we will not discuss these issues in detail, because they are not exactly related to the dividend theories. Uh, in case of dividend, there is one more issue. Dividend, there are four types of date. When a company declares a dividend, there are four dates, and as an equity shareholders, we should know what is the importance of these dates. These four dates are: the first, announcement date; second is record date; third is X date; and fourth is actual payment date, the date when the shareholders actually get the dividends. So let's talk about the first case. In the first date is announcement date. When the company decides to pay the dividends, they first declare or announces that this is the dividend rate we should pay to the investors, right? For example, normally company declares the dividend in percentage, for example, or in rupees. If the face value of a share is 10 rupees, and the company declare that we will pay 20% of the dividend, or we will pay 20% of the 10 rupees, means 2 rupees. 20% means 4 rupees. Sorry, 2 rupees. So we can convert this percentage into rupees also. So this is the date when the investor knows about the dividend declared by the company. When they know that the company will pay the dividend, this much dividend, now thereafter comes record date. The record date is the date, the day or any date when the shareholders have the dividends in their demat account. So they are eligible for the dividend. So record date can be explained as the date the shareholders, if they are holding the shares on that date, they are eligible for the dividends, otherwise not. And X date is the date when actually the impact of dividend comes in the market price. Normally, if company pay 2 rupees, the market price should come down by 2 rupees in ideal conditions. So on X date, you can see the effect of the dividend on the market price. The market price adjusted by the dividend amount. Last year, when Coal India declares the dividend of 3 rupees, on X date, the share price comes down by 3 rupees. And after X date, there is a date when you actually got the dividend in your account. Nowadays you are getting the dividend in your account, and the amount is transferred through ACS system. If you are having internet in bank account, internet associated with bank account, the dividend directly comes in your bank account. So this is the facility we are having nowadays. Now, how the shareholders take the dividends? We found that dividends play nowadays a very important role. Recently, the news comes in the market that the government is expecting more dividend from the PSUs. In the month of February, the news comes in the market. The simple reason is that they want to raise money, and disinvestment is the most popular form of raising funds. But the problem is that market is going down. Market is going down, and government is planning to raise the funds by deinvestment of ONGC and BHL. But the problem is that the market is down and they are not getting the enough funds. So they want these PSUs to declare high dividends. So we can understand that if Indian government want high dividends from the PSUs, from the companies, so why not a small retail investor want dividend from the companies when the market is not moving up, when there is no hope for the company to pay good capital gains? So simply we can understand that dividend declaration also depends upon the market conditions. When the market conditions are not very good, investors expect high dividend from the companies, and good companies, yes, good companies pay good dividends. Although most of the PSUs stay with the same policy, same dividend policy. Same dividend policy means whatever dividend they declared last year, they are paying same dividend this year also. They are not decreasing the dividend payout ratio. This is the policy declared by the many PSUs. For example, MOIL, Magnesium Ore Limited. Magnesium Ore Limited say that we will continue with the same policy, and many other companies like Coal India, they are expected to follow the same policies. Although government want more, because they are not having any hope that market will go up and they can de-investment the company. Similarly, in such kind of scenarios, when the market is not moving up, the prices are going down, investors have a confusion that whether to stay with the company or to sell it. The best way is they should have at least some dividend in their hands, so that they can have motivation to stay with the market share. So many theories say that when the market is down, the company is not having a good reinvestment rate, they should pay the dividend. This is one. And there is one theory which explains by Linter. Linter say that there are two variables which explains the dividend payout behavior of the companies. These two variables are the last dividend payout ratio or previous dividend payout ratio and the current earnings of the company. The dividend payout of any company depends upon these two aspects. This is another theory which is very popular nowadays. And according to this theory, if company pay last year say 10% or 20%, in most of the cases company want to stick. Company want to stay invested, remain same. Company want to keep the same dividend payout ratio this year also. So the past dividend payout behavior of the company also influences the current behavior, right? So from investor point of view, if you want to know that what should be the dividend payout ratio of this company this year, so better you find out their past behaviors, right? For example, yesterday when the news of this IGL came in the market, when I see the past dividend payout behavior of this company, I found that last year the company IGL, Inpress Gas Limited, the company paid 50% dividend. 50% means 5 rupees per share, right? And year before previous year, the company paid 40% of the dividend. So yesterday I thought that whether I should invest in this company or not, because in short term the sentiments are very negative. The whole market is selling the shares, right? But uh, today is 10th April, and after some days the company have to declare the dividend also. So if I apply the same theory with Interest Gas Limited, I can expect the company to pay rupees 5 at least per share. So now if I calculate the dividend yield, dividend yield is not very high. Dividend yields can be calculated by dividing the dividend by the market price. The market price is 235 today, and dividend is rupees 5. So it is not very high, but I know that if I invest rupees 235 in one share, at least I recover 5 rupees immediately. So most of the investors think in this way, right? So according to Linter, the past behavior of dividend payout ratio is also explains the new dividend payout ratio of the companies. And there is one policy which is known as stable dividend policy. Most of the companies follow this policy. Stable dividend policy means they stay with their dividend policy. For example, if company pay 20% dividend every year, they stay with it, right? So this type of dividend policy is known as stable dividend policy. We are having another policy which is known as slightly increasing policy. Means if the company is growing, in 1 year they can pay 10% dividend. Next year they can go to they can declare 12%, 14%, 15%. Means they are slightly increase. They can slightly increase the dividend payout ratio, right? And the second variable which we are talking about is current earning. Now dividend payout behavior of the company also depends upon this variable, because if the company is having good earnings in their hands, they like to declare more dividends, especially when the market is stable, when the market is not moving up. So the current earnings of the companies is one of the most influencing variable influencing the dividend payout ratio. In current scenario, we saw that the market is not moving. We are having infection from a European crisis or many other crises, right? In such a scenario, the current earnings are very important to understand the dividend payout ratio. If the companies are making good profits, they can pay good dividend. If earnings are decreasing, they can decrease the dividend payout ratio. So this theory explains the dividend payout ratio as a dependent variable which influences by past dividend policy and current earnings, right? So in total we are having four theories. One, Volter theory, Gordon theory, which say that dividend policy have a significant influence on the market price, and also we are having the Miller and Modigliani theory. This theory totally rejects the relation between dividend policy and the market price, and we are having Linter theory, and there are so many theories explained by different researchers. Now one thing which comes into my mind at this time is we can also divide the shares on the basis of their dividend distribution. The shares are growth shares. The shares are stable shares. Some companies are known as defensive companies, right? For example, if we think about all FMCG companies like Procter and Gamble, ITC, and this Unilever, these companies are known for paying good dividends. There are some companies like even some banks, the State Bank of India and some other banks, they are also have the history of paying good dividends. So we can we can keep all these companies in one category. As an investor, when you want to decide the portfolio, and we should keep some of these companies into our portfolio, because we know that whether the market is going up or whether the market is going down in the future, we don't know, but still these companies are having the good record of paying the dividends. So we should keep some of these companies in our portfolio. And some companies are growing, basically they don't want to pay the dividend. One of the company like Educom comes in my mind. This company, the dividend payout behavior is very, this company is paying very low dividend. There are so many other companies which pay very less dividend. Maybe the growth rate is very high, but in case of Educom, this company is not paying good dividend. Also, capital gain is very low. Actually, last year the price was 500. Now the share is available at just 200 rupees. So who will invest in these companies? Company is not showing growth. So when to decide the portfolio, the dividend payout behavior play a very important role in selecting the companies. So if you invest for long term, it is found that most of the investors, although investors' preferences depends upon demographic profiles, for example, gender and age and income group, it is found that most of the investors who belong to higher or upper income group, as well as they are having age more than 50, they treat these companies as a source of continuous earnings. And this concept in finance is known as homemade dividend. Homemade dividend means these investors invest their earnings in these companies and earn dividend every year. Okay. Another issue which comes in my mind is the taxation purpose. Taxation, because taxation also play a very important role in dividend distribution. We are having the system of short-term capital gain tax and long-term tax, right? In India, as per my knowledge, if you invest for more than 1 year, there is no capital gain tax. And in short term, you have to pay capital gain tax. So taxation also play a very important role. And there is no tax on the dividend. Dividends are tax-free in the hands of shareholders. So in India, especially because of this reason, dividends are tax-free. Investors wants more dividend from the companies. So if we consider tax aspect, investors prefer to have more dividends rather than the capital gains. So so taxation is also very important aspect. And there is a suggestion by some of the theories like Walter model, Gordon model. They suggest to the companies that if the company reinvestment rate is more than required rate, or which we call cost of capital, the dividend payout ratio should be 100%. Gordon say that retention ratio should be 0%, which is same thing. And for declining firms, the Walter suggests that the dividend payout ratio should be 100%, and the retention ratio should be 0%. So these are the suggestions provided by the Walter and Gordon, whereas the Millers and Modigliani, they did not have any suggestion. They only suggest to the companies that the market price actually not depends upon the dividend, The market price of the share depends upon the investment opportunities. Investment opportunities, right? Because there is a problem between the shareholders and the management, and we call this problem as agency problem, agency cost. According to this concept, the managers want to increase the business or expand the business. They want to invest the earnings in new investment, new projects, even if the today projects are giving you less returns, but they are having the hope that in future they can earn more, right? So from management point of view, from in most of the cases, from management point of view, they want to reinvest the earnings in some other investment opportunities, knowing that for some years, maybe 1 year, 2 year, 3 year, the new project will not give them good benefits, but they know that in long term these new project will give you the profit. But shareholders don't want management to reinvest the amount or the earnings in these projects, because according to shareholders, they believe that the company are just dumping the money. So there is a conflict between the shareholders and the management, right? So this problem is known as agency problem, and because of this problem, investors opposes the reinvestments, whereas management reinvest actually. In such a case, how dividend policy is important for the shareholders, because shareholders, if in this case, if company is not paying the dividend, the shareholders start selling the shares. As a result, the share price come down in short term. Whereas in long term, when they saw that the new projects start giving good benefits, they again re-enter into the share, right? Whereas the Miller-Modigliani theory say that the dividend distribution is not important. What is important, that what is the selection criteria of the company for new projects, or where they are investing the earnings. If they are reinvesting the earnings in some good investments, if investment projects, or we can say if investment projects are able to give you the good NPV or good returns, then the investor is having the hope of making good capital gain in long term. So try to analyze this psychological effect. Basically, the market moves according to the psychology of the investors. If investors thought that expansion is good, they enter into the company. As a result, the market price move up. So it is actually not the dividend payout ratio which influences the market price. It is the new investment. So selection of the new investment having a significant influence on the market price. So this theory is known as irrelevant theory, because directly there is no relation between the dividend and the market price. The market price is influenced by the growth and the investment in the new projects. So in this lecture we discussed about the basic concepts of the dividend, and we also discussed the many theories. We can summarize these theories as in two categories: relevant theories and irrelevant theories. We are having two relevant theories, Walter model and Gordon model, and we are also having irrelevant theories, for example Miller's and Modigliani theory. We also discussed the difference between some corporate benefits like dividend. Dividend, actually they are the cash benefit in the hands of shareholders, whereas bonus share is not providing any cash benefit. Actually it increases the number of shares in your account, in your demat account. A stock split, we also discussed. Stock split also increases the number of shares in your demat account. Actually there is no cash benefit from the declaration of stock split, and there are some other corporate benefits. Now, one corporate benefit I forgot, which is very important. This is buyback of the issue. Many companies recently we heard about the Reliance. Reliance announces the buyback of the share. Why? Because according to Reliance, because of the poor market conditions, the market price is going down, and investors are not ready to buy the share even at this value. The market price of the Reliance is just 752 and 750, right? Although we know that the price of Reliance 2 years back was around 1200, 15 or 1400. The share of 1400 is available today at the rate of 740, and even also the shareholders are not ready to buy at this price. So at this time, buyback emerges as a very good option of corporate benefit. Why? If you are holding the share, you are having the opportunity to give it back to the company at a higher price as compared to the market price. So the buyback from the company is also one of the good corporate benefit announced for the shareholders, right? And
so this was what dividend policy all about, and why the company apply for it. But what caution you suggest to the shareholder that they should take note of when going for
Yes.
any company?
they have to look for the past behavior of the companies regarding the dividend payout ratio, and they also look for the current earnings, because I remember one research paper recently. This research proved that if you stay invested in the market for more than 10 years, you can earn 15% to 16% rate of return. So investment in equity share is very good from long term point of view. But now what I see in the market, investors are investing for short term. This is wrong. This is my suggestion to the retail investors to select the good companies. Now, one investor asked me how to select good company, or what is the definition of the good company. So my suggestion is, good company means good future growth, good earnings. Compare their earnings. Try to find out the trend of the profit, trend of the earnings made by the companies. If company is showing good trend, good long term trend, so select these companies for your portfolio and invest. And so earnings is one of the most important indicator to represent the future growth of the company. Now, for example, in today's scenario, Bharti is showing a very good profit. Even HDFC Bank. I remember that this HDFC Bank declares 36% growth in the profit. 36% growth in revenue in this scenario is very good. So go for the earnings.